Good day to all of you. Lesson 2 for today is lesson 2, chapter 26, fiscal policy. In lesson 1, we discuss about the budget, three types of budget: budget deficit, budget surplus, and balanced budget. So, of course, we discussed a little bit on the planned government revenue and planned government expenditure. We discuss about the two types of government expenditure, reasons for government expenditure, reasons for taxation, right? So in this lesson we're going to mainly discuss about the taxation, types of taxes, tax structure, impact of tax, and also principles of tax. Okay, so let's go into the lesson. Instructions for students are required to read, watch, and do. Read Econs Cost Book chapter 26 page 229 to 233 together with the attached notes. Watch video presentation on lesson 2, this video presentation. Do 4-part questions, question A and B only, page 236, and worksheet uploaded in the Google Classroom. Learning objective: by end of this lesson you should be able to define tax, describe types of taxes, direct tax and indirect tax. You should be able to define and describe it. Explain 3 different types of tax structures. Okay, progressive tax, regressive tax, and proportional tax. And finally you should be able to analyze the impact of taxes. So taxation, or what is taxes? Tax are payments made compulsory or mandatory by laws. Okay, non-payments or tax evasion are punishable. It's a punishable offense. All right. So there are 2 main types of taxes. One is the direct tax. The other one is the indirect tax. Okay, direct tax and also indirect tax. So direct tax imposed on income and wealth. Okay. So direct tax for income and wealth. Like for example, if you earn, you pay. You earn income, you pay tax. It's a direct tax. You earn, you pay. When you say you cannot transfer to another party, it's your earning, it's your responsibility to pay. So you cannot ask other people to pay. Therefore, the tax burden is fully absorbed by the taxpayer and cannot be passed on to the others. All right. So that is the direct tax. A good example of direct tax like income tax or corporation tax. Okay. So the other one is the indirect tax. Indirect tax is what you spend, you pay tax. Okay, tax paid on expenditure. Okay, you spend, you pay tax. Therefore, the tax burden can be transferred to the other party. Usually, producers will share the tax burden with the consumers. That's a good example of an indirect tax. Another example, some specific examples of indirect tax like GST, SST, or what value added tax, goods and service tax, and SST. Yeah. Okay, so indirect tax, I repeat, imposed on the expenditure. You spend, you pay tax is indirect tax. You earn, you pay tax is what? Direct tax. Okay, so let's move on. Types of taxes. We got direct tax. This is what we discussed. Direct tax are imposed on individual and firms' income and wealth. Okay, imposed on individual and firms' incomes and wealth. Okay, so tax burden that fully borne by the individual or firm. Okay, individual will earn income, so it's going to be an income tax. Firms, they're going to make profit, there's going to be corporation tax. A corporation tax or company profit tax mainly is a corporation tax. Therefore, tax burden cannot be transferred to another party. Okay, all right. So examples: personal income tax, corporation tax, and other wealth related taxes like inheritance tax, capital gain tax. All right. So capital gain tax is what? Tax paid from your, tax pay for the return or interest on the investment. It's also a taxable income. Okay. So next we move into the indirect tax. If you look at the indirect tax, are the taxes imposed on what? Spending. So expenditure done on goods and services. Expenditure done on goods and services. So like a business transaction or trade involves both what producers and sellers, producers and consumers. Hence, indirect tax burden can be transferred, can be shared, can be passed on. Okay, so usually producers will share the tax burden with the consumers to pay to the government. Okay, example is what? Example of tax will be export duties, import duties, sales tax, GST, SST, and VAT. So tax structure, there are three different types of tax structure: proportional tax, progressive tax, and regressive tax. Progressive, the word progressive means rising, increasing. So therefore the tax rate will increase as you earn more with your level of income. If your level of income increases, the tax rate increases. Okay, you have to pay more tax rate if your income increases. Is a good example of the progressive tax. Whereas if the tax rate decreases together with the level, as your level of income rises, therefore it's going to be a regressive tax. If the tax rate is flat, no matter your income level rises or falls, it's going to be a proportional tax. Okay, so before we move on, it is important for you to know how to calculate the tax rate. Tax rate is very simple: amount of tax paid divided by the level of income times 100. Okay, I repeat, amount of tax paid, okay, divided by the income times 100% is how you calculate the tax rate. A good example, let's say you paid tax for 200 ringgit. Your income is $1,000. Let's say you earn $1,000, you paid $200 as your tax. So 200 divided by 1000 times 100%, you get 20% of the tax rate. 20% is a tax rate. So progressive tax, if you take a look at the diagram, the table here, you can see the level of income rises from from 100 to 200, 200 to 300. But if you look at the tax rate increases from 5% to 12%, 12% to 25%. This is a good example of the progressive tax, where you can explain, or we can define progressive tax as the tax rate increases as the level of income rises. I repeat, tax rate increases as the level of income rises, right? So based on the table, as income rises, let's say from $200 to $300, the tax rate also increases from 12% to 25%. 12% to 25%. In contrast, let's say tax rate falls from 12% to 5%, therefore the level, it means the level of income falls from $200 to $100. Okay, so you pay lesser tax rate as if your income falls. Okay, whereas you pay more tax rate as your income rises. Okay, therefore this is what we call as the progressive tax. Progressive tax. Okay. And progressive tax, I can say the tax rate is what? Positively related with the level of income. Okay, positively related or directly related to the level of income, where tax rate rises as the income rises. Okay, but there are few disadvantages of the progressive tax. Progressive tax is very famous tax structure. Okay. It is a good strategy for income redistribution. Okay, usually government will impose progressive tax on the rich group. Okay, and collect the tax revenue and redistribute the tax revenue to the poor in the form of the transfer payment. Okay, however, there are few disadvantages. Okay, mainly it could be a disincentive to work. Okay, where progressive tax imposition of progressive tax can be a disincentive to work, and also investment. Okay, where it discourages discourages and demotivates the high income group, okay, where they usually the high income group complain that they have been punished for working harder, okay, because as they work harder, okay, they earn more. As they earn more, they have to pay more tax. So they claim it is a punishment for the high income group, but it is important for the government to reduce the gap between the income gap between the rich and poor. So this is a very good strategy for to reduce the income gap between the rich and poor, where they can tax more on the rich society or rich group of people and redistribute the income to the poor. So in the case of individual, a progressive tax on higher income group tend to lead to lower disposable income. So that's where the frustration starts. Okay, where you can see that disposable income means the income after tax, where gross income minus the tax. So that will be the disposable income. So high income group will be demotivated and discouraged with lower disposable income because they are paying higher tax. So much of tax paid, right? This lead to lower work efforts. Okay, this demotivates and lead to lower work efforts from this high income group, mainly professionals. Okay, this also will affect the aggregate supply, where the AS can fall, leading to reduction in the output, employment and economic growth. Okay, similarly, higher tax on corporation on the firms also will discourage investments. Okay, because the firms are compelled to pay so much of tax from their profit. They make more profit, they have to pay more tax. So it is discouraging for the firms to do more investment, okay, for business expansion. Okay, this demotivates, or it's being a disincentive to what professionals, high income earners, and also to firms. So the long term effect of the progressive tax is disadvantage of the progressive tax is it may lead to brain drain, where some professionals may leave the country because they have to pay so much of tax from their income. Okay, or some companies may relocate, okay, or may search for a better for more attractive tax rate for more other places where other government or other countries where offer a lower tax rate of with a different tax structure, okay, like a proportional tax structure. So this will cause brain drain. Thus, highly productive and efficient professionals and businessmen migrates abroad. Okay, they may move to other country, okay, which offers a better tax rate. So next type of tax is the proportional tax. A tax system is described as the proportional as the percentage remains the same. Okay, this is not number 5, it should be the percentage remains the same irrespective of changes in the income, as shown below. If you take a look at this, the tax rate is flat rate, the same amount no matter you earn more or you earn less. Okay, no matter the level of income is high or low, the tax rate is flat rate. 10% means you still have to pay 10%. So good example of a proportional tax rate is corporation tax or company profit tax. Another name for corporation tax is company profit tax. Next is regressive tax. In regressive tax, you can see the tax rate reduces as income rises. Okay, you earn more, you pay lesser tax rate. Okay, so a good example of the good example of regressive tax. You can see most of the indirect tax like GST is a regressive tax, SST is regressive tax. Okay, all right. So so let's move on to the next slide. So next is the principles of taxation. Okay, economists describe a good tax should have the number of principles. Okay, a good tax means what? Okay, the good tax must be must follow certain principle. The first principle is what? Equity. Second principle is what? Economical. Third is convenience. Fourth is what? Certainty. Okay, other points like flexibility and efficiency, all that covered in your textbook. Okay, you can do a little bit further reading on the other 2 points, but mainly the principles of tax or taxation includes, number one is equity. Okay, equity talking about the fairness. Fairness means must be based on the ability to pay. Meaning to say, a rich person able to pay more tax, a poor person or can only pay certain amount of tax. So therefore, it must be fairly distributed depending on the income level. Okay, that is the first principle of the taxation, where equity, fairness. The second important point, or the second important principle of taxation is what? Economical. Okay, the cost of collecting tax should be low as possible. Meaning to say, it must be lesser than the revenue made. Okay, the tax amount must be lesser than the revenue from the earning. So let's say somebody is earning about 5,000, the tax imposed on the earnings must be less than 5,000, must be less than 5,000, or low as possible, Okay, so it must be economical. Okay, the tax must be economical. The third important point here is the convenience. Okay, so the process of tax must be easy to pay. It mustn't be very complicated or difficult. It must be easy to pay and easy to collect tax by the government. Okay, convenience okay, that is going to be the fourth principles of tax. A good tax means the fourth criterion is the convenience. The last one is certainty, meaning to say tax must be clearly defined, and taxpayers should be able to calculate how much tax they should pay. Let's move on the impact of tax. Okay, the impact of tax mainly using the indirect tax. Where consumers and producers can share. Usually they will share the tax burden together. Okay, so in this case we can explain the impact of tax using a simple demand and supply diagram or demand and supply framework. So you can see indirect tax is a supply side factor, so it will only affect the supply, not the demand. So when government imposes an indirect tax, therefore the supply will reduce, the supply curve will shift to the left. Okay, so this is a basic understanding on the demand and supply. Indirect tax affects the supply will reduce to the left. Okay, from S0 to S1. So let's zoom into the diagram here. So you can see the initial equilibrium point is at point E. New equilibrium point is at point F. So if you look at the initial equilibrium point at point E, the point E establishes when the demand curve cuts the supply curve, S0. Demand cuts the supply, point E. At point E, the price is P0, or let's say $20, and the quantity is what? Q0 at 100 units. Okay, that is the initial equilibrium point. Okay, so when the government imposes tax, okay, the supply falls. Okay, the supply falls because when the government imposes tax, this will increase the cost of production for producers. Okay, as indirect tax increases the cost of production for producers will make lesser profits. Therefore they choose to supply lesser. When they choose to supply lesser, it means they are they are cutting down the supply. As they cut down the supply curve will shift to left from S0 to S1. As the supply curve shifts to S0 to S1, we can see there's a new equilibrium point established at point F. Okay, and now the price is at P2, where the price has increased from P0 to P2, whereas the quantity decreases from 100 units to 80 units. So from the point F, draw a straight line vertically down. Okay, bring it down until it touches the original supply curve. Okay, and bring it to the vertical axis, the price axis. So label it as P1. Okay, so now you can see there's a box here. Okay, we can see P2, F, A, B, P1, P0. Okay, there's a box there. So we can see that, okay, there's upper part of the box and lower part of the box, or we can say there are two boxes over there. P2, F, A and P0 is one box. We can say upper part of the rectangular box. P0, A, B and P1 is the lower portion of the rectangular box. Okay, alright, you can see that. So usually, please memorize this, the upper part of the box is the tax burden bared by the consumers. Okay, which is P2, F, A and P0. Okay, the upper box is the amount, total tax burden paid by the consumers to the government, whereas the lower box is which is P0, A, B and P1. The lower box is the amount of the tax paid by the producers to the government. Okay, so from P2, P2, F, A, B, P1, P0, the total is going to be the total of both consumers and producers paid tax burden to the government. Alright, so now here, if you want to calculate the tax per unit, is going to be P2 minus P1. Okay, how much tax the government imposed to the on a particular good. Okay, so it is P2 minus P1. Okay, which is 23 minus 18. So $23 minus $18, you get about $5 per unit. So that will be the tax charged or tax imposed on per unit of good. Okay, tax imposed on per unit of good is what? 23 minus 18. Okay, 23 minus 18. So that is going to be the gap between the two supply. That will be the gap between what? Two supply, or the vertical distance of what? FB, the straight line. That's going to be the supply, the gap of the supply, the gap from the S0 to S1. So how much the vertical gap? So that will be the tax paid on per good, tax amount paid on the per good. So from, let's say it's $5. In this case, you can see the 23 minus 18 is $5. So with the $5, how much is shared between the consumers and producers? You can say the upper box, the upper portion, which is 23 minus 20. 23 minus 20 is going to be the amount contributed by the consumers for 1 unit of good. Like for example, 23 minus 20 is $3. $3 paid by the consumers, and $2, which is 20 minus 18. $2 paid by the producer. Okay, so that's how we get about $5. Okay, $5. So this is how you can explain the impact of tax. Alright, so let's take a look at the elaboration. So how to elaborate is very simple. You must see the initial equilibrium of the market. The initial equilibrium established at the point E when the demand curve cuts the initial or original supply curve S0. Therefore, the equilibrium quantity is what? 100 units. The price is what? Equilibrium price is $20. So let's say government imposed an indirect tax about $5 per unit. So what happened to the demand and supply? Question mark for you. Question mark given here to ask you what will happen to the demand. Nothing will happen to the demand. Demand will not shift either to right or left, whereas supply curve will shift to the left from S0 to S1. Okay, so therefore there will be a new equilibrium point established at point F, where S1 cut when the S1, a new supply curve cuts the original demand curve. Hence, new equilibrium price P2 or $23 and Q1 at 80 units. At 80 units, please refer to the diagram. Therefore, an indirect tax tends to raise the market price from $20 to $23, while reduces their equilibrium quantity from 100 units to 80 units. Please refer the diagram. So we can calculate the distribution of tax burden. As I told you earlier, by looking at the diagram itself, we can calculate how much tax paid by the consumer, how much tax paid by the producer, and what is the tax amount, how much tax charged on per unit, and what is the total amount of tax collected by the government. Earlier we calculated 23 minus 18 is $5. So $5 for 80 units. So 5 times 80 is what? 400. $400 collected by the government. Okay, I repeat, $5 per unit. Government charges $5 tax per unit. The total number of units in the new equilibrium is what? 80 units. So 5 times 80 is about $400. So let's look at the distribution of tax burden. Okay, we can also say the original price is P0 at the $20. The price after tax is what? Is $23, where when the supply reduces, the price increases. Okay, when the supply reduces, price increases. Therefore, the net price, okay, which is price after tax, accrues to the producer, P2 minus the tax. P2 means take the new price minus with the tax rate, which is 23 minus $5, you get $18. Okay, so that is the net price for the seller. Actually, seller may charge $23 to the consumers. Okay, seller may charge $23 to the consumers, but actually it's not all $23 is his revenue. Okay, right? It's not the revenue or the net price of the producer. Actually, the net price of the producer is actually $18. Okay, where $5 will be paid to the government. Okay, so tax burden on the seller is what? $20 minus $18. So that means the seller is paying about $2. Okay, this one can be calculated by minusing P1 from P0. Refer to the diagram. Tax burden on buyer is what? 23 minus $23, which is P2 minus P0. So that means consumer paying about $3, producer paying about $2. The total is about $5. The last part is total tax collected by the government. Okay, very easy. Just remember, tax per unit times with the new equilibrium quantity. Okay, $5 times 80, which is 400. So if you have any question on this area, please feel free to contact me. And that's all for today. Thank you very much.